This is a demonstration of exercise 544, estimating uncollectible accounts and reporting accounts receivable. Collins Company analyzes its accounts receivable at December 31st and arrives at the age categories below with the percentages that are estimated as uncollectible. The balance of the allowance for uncollectible accounts is $1,100 at December 31st before any adjustments. So the problem has given us the aging of the accounts receivable. They have divided up the total accounts receivable based on the number of days that those accounts are past due. And they've also given us the estimated loss percentages for each of the categories. And we know that as the accounts become more past due, the percentage that is uncollectible will go up. So in Part A, it states what amount of bad debts expense will Collins report in its income statement for the year. So to determine the bad debt expense, we need to take each one of the amounts in each category and multiply it by its loss percentage. And we get the amount of bad debts that we expect for each of the categories, and then we add all of those together to get the total amount that we need in our allowance account for the next year. Now, when we use this method, we also have to take into account the balance that is already in the allowance account. So we're going to subtract the $1,100 balance that is already in the account, and the difference, $5,800, will be the amount of bad debt expense for the year. Now, the B portion states to use the financial statement effects template to record Collins' bad debt expense for the year. So we know that the allowance for uncollectible accounts has a normal credit balance. It's a contra account to accounts receivable. So it will be a non-cash asset, and that will be a reduction, again, because it's a contra asset. Also, we know that the bad debts expense will flow through eventually to retained earnings, and that will reduce retained earnings. On the income statement, the bad debt expense will increase expenses and decrease net income. And we can see the effects of this transaction in our T accounts. We start with our balance of $1,100, and we're going to have a credit to our allowance for uncollectible accounts of $5,800, and then that gets us to that $6,900 balance that we calculated in Part A. And then we would also have a debit to bad debts expense. The C portion states what is the balance of accounts receivable on the December 31st balance sheet. So we know that our accounts receivable is $200,000 and our allowance for uncollectible accounts is $6,900. So the net amount of accounts receivable would be the difference, $193,100, and so that is the amount that we would report on our balance sheet. And this is the conclusion of the demonstration for exercise 544.